A lot of people think they know what retirement's going to be like, but then they're met with all kinds of surprises once they're actually there. In today's video, I'm going to share with you the 5 most common misconceptions about retirement so that you can better plan for yours. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. Going into retirement, you don't want surprises, at least not bad surprises. You want to know, at least from a basic standpoint, what can you expect financially as well as non-financially. Well, in today's video, I'm going to share with you 5 things that people commonly get wrong about retirement so that you can avoid making these same mistakes when it comes to your plan. One of the first mistakes people make when it comes to planning for their retirement on the financial side is they think they can rely upon 2 incomes forever. What do I mean by this? Well, let's assume that a couple wants to spend $8,000 per month in retirement. Let's also assume that both spouses, have $3,000 per month coming in from Social Security. Well, in this case, if $6,000 is coming in from Social Security, $8,000 is what they want, only $2,000 needs to come from their portfolio. So if they had about $500,000 generating 5% per year on income, that would about cover the gap. But what happens in the event that one spouse predeceases the other? Well, Social Security in that case would be cut in half. So now all of a sudden, if you want to live on $8,000 per month, you don't have $6,000 coming in to help support that. You have $3,000 per month coming in. Now granted, some of the expenses will probably go away, but they won't be cut in half. So now all of a sudden you're in this difficult position. If one spouse passes away, your portfolio needs to do a lot more legwork. And you can't just ask your portfolio to fill in the gap there. It's going to be bound by certain safe and sustainable withdrawal rates. So if you're going into retirement expecting to have 2 incomes forever, and if one of those incomes is unexpectedly cut short, it's going to be a very difficult thing for your plan. You're going to have to make some major adjustments. So as you're looking at retirement, plan for contingencies. It's not fun to talk about, but how can you protect yourself? How can you protect your surviving spouse? Make sure that you have an understanding that we can start with 2 incomes, but if something happens to one spouse first, what would be our fallback plan? Do we make sure we have more saved in retirement assets to cover the shortfall when that happens? Do we make sure there's some expenses that we could potentially cut in that event if something happens? Would you sell the home and downsize to cut expenses if something happens? You need to make sure there's a plan, because when the spouses both think we can rely upon these incomes forever, they both live the same number of days, that's right, but if they don't, there's going to be a shortfall. So make sure you're planning for that ahead of time. The second misconception people have about retirement is that the stock market is the biggest risk to their success. Now, this is understandable. When you look at the stock market, who doesn't have a story about a relative or a coworker, someone who wanted to retire, but then there was a major bear market and they had to keep working much longer? Well, in some cases that's true. In some cases it's due to improper management of funds, but here's what I want you to focus on. Let's actually look at the risk of the stock market and compare that to what most of us might think of as risk-free. So 1-month T-bill, which is essentially a bond that the government issues for 1 month and will pay you interest, a small amount of interest, for holding that bond for 1 month. Well, if we go back over the last 80 years and say what was the worst ever 12-month return on the S&P 500, so we'll use that as a benchmark for the stock market, versus what was the worst ever return on a 1-month T-bill, the differences are astounding. The worst 1-year return on the S&P 500 was down 43%. So if you have $1 million in your portfolio, 1 year later, that $1 million is worth $570,000 if it's all invested in the S&P 500. It's a very difficult thing to stomach. It's a very difficult thing to go through and to recover from. Now compare that to a T-bill. The worst ever 1-year return on a T-bill over the last 80 years it returned 0.01%. So a positive outcome. Now it was a negligible amount of interest, but it was still a positive outcome. So when you're comparing these two, it's easy to see why people say, hey, the stock market stuff's super risky. There was a year where I lost 43% of my money in the stock market, whereas with a T-bill, my worst ever experience was gaining 0.01%. It's not gonna make me rich, but it's certainly not gonna make me poor in that year. So of course this seems more risk-free. Well, that's only after 1 year. The hard part about understanding retirement is retirement's much longer than 1 year. You might have a 20, 30 plus year retirement, so we have to look at big picture here. Let's zoom out. What was the worst ever 20-year return on the S&P 500 over that time frame? So over the last 80 years, all the different rolling 20-year time periods in the midst of that range, what was the worst case scenario in the S&P 500? Well, the worst case scenario in the S&P 500 was it gained 4.8% over 20 years. Now, what I mean by that is 4.8% on average per year, and that was starting April of 2000. So if you put all of your money into the stock market, into the S&P 500 on April of 2000, you only averaged 4.8% per year for the next 20 years. Now, this isn't a very good return because historically the index has done more than double that, but over your 20-year time period, that's your worst case outcome, doesn't start to seem as bad. And we see that the worst case scenario for a T-bill over 20 years was a return of 1.14% per year. So what we start to see is in the short term, the T-bill is much safer than the stock market. But when we start to expand that to 20 years, the worst case scenario, now granted the future, anything could happen, but if we're just looking at the past 80 years for perspective, the worst case scenario for the US stock market over the last 80 years returned more than 4 times what a T-bill would have done in the same instance. So it's 4.8% for the S&P 500 compared to 1.14% per year for a T-bill. What does that look like practically speaking? Well, if you invest $100,000 into the S&P 500 in its worst 20-year period over the last 80 years, that $100,000 grew to about $255,400. So a pretty decent return. Had you invested into T-bills instead because you're concerned about what the stock market does in the short term, those T-bills would be worth $125,400. So $155,000 of growth and change invested in the market compared to $25,000 of growth invested in T-bills, you can start to see what is actually more risky. In the short term, it's absolutely the stock market. But if you have a long enough time horizon, now all of a sudden, the thing that's going to return the least is probably the thing that's most risky. So how do we make sure that we're viewing risk properly in the right context? And this ties into the third mistake or misconception that people have about retirement is when they're planning for retirement, they're ignoring the impact of inflation. Now, if you look at inflation historically, it's been around 3% per year. It's been much higher here in the last year or two, but historically it's been about 3%. So let's look at our last example here to see how this risk plays out. We looked at what if you invested $100,000 into the S&P 500? What if you invest $100,000 into 1-month T-bills? And we saw that one gave you about $255,000 in the worst case scenario for the S&P 500, and one gave you about $125,000 if you had invested in T-bills in their worst 20-year time period over the last 8 decades. Now, it seems like both of those had positive outcomes until you factor in inflation. If we just assume an inflation rate of 3%, then your $100,000 would need to grow to $180,000 just to offset the impact of inflation. So not to grow your money, not to grow your real net worth, but just to keep up with inflation. So now when we compare $180,000 to T-bills that only grew to $125,000, if you invested $100,000 in their worst ever 20-year time period, you can start to see there's a loss there. There's a nominal return, but there's a real loss. Now, as you apply that to the rest of your plan, over the course of a 30-year retirement, you can expect your living expenses to go up 2.5 times if there's a 3% inflation rate. Meaning if you need $100,000 to live on in year 1 of retirement, and expenses stay the same, but go up with inflation, you would need close to $250,000 by your final year of retirement simply to maintain what $100,000 could purchase today. So when people ignore that, what they do is they plan for an income amount, but if that income amount's not adjusted for inflation, your purchasing power is declining every single year. So you cannot ignore the impact of inflation if you want to build a proper retirement plan. The fourth mistake people make about retirement is they consider their home a retirement asset. Now, this is not a video about whether real estate's a good investment or not. That's a different topic for a different day. This is a video all about understanding the role that your home would play in your retirement portfolio. It's about, is your home a great retirement asset, not an asset in general? Now, what makes something a good retirement asset? Well, it's something that can create income for you, either through dividends or interest and actually create an income, or appreciating in value so you can sell it and live on the proceeds. Now, unless you have an intention of selling your home is not creating income for you. Now, granted, this is a different story if you rent it out or if you do some type of reverse mortgage or refinancing or something else, but I'm going to table those for now. If you just look at your home as a wonderful place to live in and to stay, it's not a retirement asset. I don't care if your home's appreciating by more than the stock market every year. If you never plan to sell or if you never plan to somehow monetize that, it's not a retirement asset. Retirement's all about generating cash flow. How do you generate income that's sufficient to meet your expenses? If you have a home, even if it's worth $2, $3, $5, $10 million, if it's not generating income, it's not a retirement asset. In fact, I would argue it's a liability. The greater the value of your home, the higher your property taxes. In general, the higher the maintenance costs. That's adding to the expense side of the equation in retirement, not the income side. So when I hear people talking about, oh, I'm going to retire and it's going to be wonderful and I've got a great net worth, but look at their balance sheet and the majority of their net worth is in their home, that's wonderful, but how are you going to generate income to meet your needs? We can plan for your home as part of your overall net worth, as part of your legacy strategy, or part of your retirement strategy if you intend to sell it or somehow monetize the equity in the home somehow. But if it's not going to, then it's not part of your retirement plan. And then finally, the fifth misconception people have about retirement is that they'll love not having a job. Now, here's the interesting thing about having a job. You probably will love not having any deadlines anymore, not having to wake up early to go to work, not having to report to that boss you don't really like. However, there's two types of freedoms. There's the freedom from, and there's freedom to. When you retire, you'll have freedom from. Freedom from those deadlines, freedom from those coworkers, freedom from doing those things you don't really want to do. The harder part, though, is the freedom to. You have the freedom to do whatever you want, to do what activities you want, to spend time with who you want, to spend your days doing only things that you want to do. To a lot of people, that's very scary. So all they think about is the freedom from having to work anymore. If you're not also thinking about freedom to, and how do you create your routine and create your structure and create your intentional life, you're probably not going to love not having a job as much as you thought. And in fact, if you don't get this right, you may just be aimless. You may wander throughout retirement, not really knowing what to do with your days after having freedom from your job. So make sure you understand the other side of freedom, the freedom to pursue what you want to do. I don't care how financially squared away you are, if you don't have that piece right, you're not going to enjoy your retirement. So yes, it's good to have the freedom from, but create that freedom to and have an understanding of what you're going to use that freedom to do. So to me, that last point is the most important one. The biggest misconception people have going into retirement, you need to make sure you have a plan for what you're going to do. Now, for more information about what to expect in your first few years of retirement so that you can create that plan, be sure to check out this video here where I walk you through just that. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.